Peter Garnry joins us, head of equity strategy at Saxo Bank. Peter, I love your chart in the back of your research note on the output gap. We are priced to March of 2001 perfection. Then we go back to just before the 73-74 recession as well. Are we as overpriced as we are in March of 2000, 2001? And does that mean we're going to enjoy a bear market like we saw then?
I don't think we are that overstretched. I think the output gap is probably something more that the Fed is looking at as a guidance to where to set rates. And as we just recently have written to our clients, we think actually the Fed is beginning to change its view and will hike in December. But then I think it really begs the question here whether they will hike 2 times or 3 times next year, or actually maybe only 1 time. And we are leaning towards maybe only 1 time. There's definitely softness in the economy, but the output gap is just a measure of U.S. activity. And U.S. activity looks quite solid at the moment, although we expect softness over the coming months as this trade war between the US and China will begin to have an impact on the US economy, and the tailwind from the US tax reform, etc., is also coming off as we move into the next year.
With what we saw yesterday, what you see this morning in Europe, what are the correlations that interest you now?
So obviously the sell-off in technology is interesting, right? Finally, we see technology being discounting what we have been saying for a couple of quarters, that growth stocks would be hit as the growth sentiment is coming down. And it's all tied to China, and that links back into Europe. So the reason why we're seeing Europe being so weak is, one thing is Brexit and Italy, but it's definitely because of what was said earlier in the show. The connection, the trade link between Europe and China is very deep and has been deepening over the years. And so everything depends on what happens to China. So the G20 meeting on the 30th is very important for global markets, where we head from here. And as in technology, if we stay on that, it's just simply that the growth is being discounted. But I suspect that buyers will be coming in if we move 5 to 10% lower from here. Because if you look at some of the big names, they are quite solid. They're quasi-monopolies. If we take Facebook and Google, they have amazing free cash flow generation. And Facebook right now is priced at a 5% free cash flow yield. I mean, I think that's pretty attractive given the profile of what you're looking at elsewhere in the equity market.
Peter, what should pessimists trade in the U.S.-China dispute? What asset class or what particular equity sector?
Well, that would still be underweight technology, specifically semiconductors. But then you could broaden it out. So one of our potential wild bets for next year is if things go south, then the whole corporate credit space could be something that could take investors or spook investors. I think GE right now is peaking out there as potentially to a downgrade. Could that have shockwaves and ramifications to the big, large segment where the BBB is where we have seen the most growth in corporate debt issuance since the great financial crisis, and that really is something that could spook the market. So that would be the wild bet. But otherwise, underweight the cyclical stuff. That's for sure. But having said that, our main bet, and that's I think what people are getting wrong. Investors are so negative on China. And most of those that are negative on China has not been on the ground in China. I think China still has ammunition, and then when we get into the late part of Q1, I think a lot of that stimulus that the Chinese government have been implementing, that will begin to work, and that's why we're staying overweight China and Europe and underweight the US.